Hi, there's an old Wall Street saying that the market's job is to cause the most pain to the largest number of investors. That's why what causes the most pain is what's most likely to happen, allegedly. Let's play out such a hypothetical scenario for fun. Right now, everyone is convinced the market is about to crash soon, so most hedge funds are very short. How short? As short as at the bottom of the COVID market in March 2020, all the way to July, which of course was the best time to buy. So, hypothetically, this would mean the pain trade today is not a crash, but a market zoom. Market zoom? At this level? Am I serious? Remember, this is neither a forecast nor a recommendation, just a fun hypothetical scenario. A what if? Since everyone is convinced the market would crater, the pain trade is that it will not. Not yet, anyway. Not with everyone so gloomy. Rather, the hypothetical is that the market keeps sailing up and up until everyone breathes a sigh of relief and becomes cheery. And then the market will crater, hypothetically. All right, let's hypothetically assume the market first rises here some more until everyone is optimistic. Under such a scenario, one must wait for optimism before selling. And then what? Going to cash? And what kind of cash? US dollars, Canadian, euro? Here is where the hypothetical fun begins to come in. Assume that after the huge Fed printing, the economy here, like a zombie injected with heroin, keeps rocketing up some more and more, causing pain to all the shorts. But as the economy zooms and the market rises to the scream of pain by shorts, so does inflation rise. And not just 3 or 4% inflation, but 5 or 6% or more. And only then, so goes the hypothetical, does the Fed panic and pulls back on the printing press. And it is only then that the market craters, hypothetically. Besides, in the face of higher inflation, eventually, even if the Fed doesn't pull back, the bond vigilantes will by selling bonds, which will raise long rates. And then the market waterfall would start, hypothetically, as large banks begin to buckle. Then maybe a country here and a country there also says it's broke, and before you know it, institutions with hundreds of billions get margin calls, hedge funds get a lot of redemption notices, and then eventually, like a herd of elephants, all trying to access to the same narrow door at once, all press the sell button. And down she goes, eventually, hypothetically, but not yet. For this one, we have to wait for optimism, which would be the pain trade then, eh? But what then? What would an investor prefer to be in as optimism breaks out? In cash? And if so, which currency? Okay, so now starts the real fun part of the hypothetical. In a scenario where the financial world gets unraveled, the only safety is in arms. And no, I don't mean one should go and get oneself an Uzi or a Glock. I mean the most powerful government will have the strongest currency because the extreme is the strongest army that defends law and order, which all currency is based on. And even after Biden's shameful cut and run in Kabul, the American army is still the strongest on the planet. So in a hypothetical crash scenario, slow or fast, one would want to be in US dollars, but not yet, because long rates haven't gone up yet in this strong economy. But once they have shot up in a few months and start falling again as the economy finally weakens, this is when the slow crumbles will start. And then one would want to be in US dollars, hypothetically. But not just in US dollars, but in US T-bonds. T-bonds, whether 20 years or 30 years a matter of taste. Why bonds? Because in a hypothetical global panic, with banks wobbling and Fed officials wetting the floor, the best piece of paper anyone would want to own would be US T-bonds. Because in such a hypothetical global panic, as the economy cracks, demand for working capital would plummet, and US 10-year rates would fall from 2 or 3% by then to zero. And if 10-year rates fall from 2 or 3% to zero, what do you think will bonds do? Yes, they will zoom. And since T-bonds are denominated in US dollars, the US dollars itself would zoom also, hypothetically. Everyone on the planet would like to be in US T-bonds for the double benefit. So, an investor living in Euroland, or in Canada land, or in any other non-US land, who sometime before year-end has luckily sold his or her stocks in time and bought USD bonds might make 30% or 40% on his or her holdings in his or her local currency. Hypothetically, of course. As I said, the above is merely a what-if, not a recommendation. And besides, the market hypothetically still has a way to rise in a pain trade of no crash yet, before both the economy and the market finally crack as fear recedes and the pain trade will shift to optimism, hypothetically. And since we are still in the hypothetical realm, we can also mention that 20-year bonds can be bought directly, of course, but can also be bought via the TLT ETF, and that the double 20-year bond ETF is the TMF. Normally, holding a double ETF for long is a terrible idea because of the melting volatility that melts the price. But every now and then, it's not so terrible. What of gold? Gold is good and cheap. But in a hypothetical world shaking stock crumble, everything would go down, everything except bonds, that is, so gold might go down too temporarily because it doesn't have an armed government behind it like T-bonds do. Later it would go up again and much higher, but that's later. So, once more, the above is not sleuthing, nor is it a forecast. It's just a hypothetical fun scenario based on fun conversation with old friends of mine who, like me, are ancient and have gray hair and have been in the market for decades and like to play what if sometime for fun and the occasional profit. That's all for today. Please let me know what you think of playing with hypotheticals. And if you like it, please subscribe and tell all your friends who they subscribe to. I'll see you next time. And meantime, thank you very much for your attention.